Good afternoon, Market Chameleons, and welcome everyone to our aftermarket show with our best friend and great chameleon, the Doctor, Jake Kilby. How you doing, Doctor?
I'm really well, thanks, Will. Great to see you. Great to be back online.
Really appreciate you coming on and talking puts today for the community. Whoop, whoop. Sorry about that. That's a technical difficulty. My apologies.
No
Let's
problem.
before we get started, let's go through the disclaimer. Market Chameleon is not a registered investment advisor or a broker dealer. Either is Jake. We're here for informational purposes only. Take a quick look at that disclaimer. With that, we will get started, Jake. You want to let people know a little bit about yourself before we get going?
Yeah, sure. So I'm Jake. I've been probably with the Market Chameleon as a subscriber with Market Chameleon for about over 3 years now, and trading holistically options, etc., futures as well. And that I do that pretty much as a side hobby. I've pretty much also spent, I guess, from a career perspective, a lot of my time in natural resources, right? So particularly the oil and gas industry on drilling and exploration side, and then just recently in mining. So natural resources overall. Normally I live in Malaysia, but right now I'm living in Africa. Hence me being offline, but I'm going to show you a little bit about that as well, and we're going to go over some short puts, which should be fun.
Now, should I start? Jake, I did want you a little. I just personally I wanted to always ask this question: how did you end up? You were born in Australia, went to university in England. Correct me if I'm wrong on this progression.
No,
how did you end up in Malaysia? Oh,
Okay,
you went to university in France.
Yeah, so basically left Australia when I was about 19, did all my education, so my bachelor's, my master's in, you guys call that college in the States, did that in France, worked in the UK for about 10 years, and it was actually a chance opportunity by a headhunter who was looking for someone to work in the oil and gas industry in Malaysia, but someone who was actually educated in France because it was a French company. So that was really just more luck than anything else. And then after that, been pretty much all over the place, right? So Madagascar, Nigeria, I'm in Senegal now, but I travel pretty much all over the place, like I'm going to show you guys as we go on.
Very cool. Very cool. All right, let's get started. How do you want to take questions, if there are any questions?
As and when they come would be pretty cool. Yeah, I think it should be okay.
All right, perfect. Here we go.
Yeah, so let's see. Can you see my black screen there?
Black screen's up.
Okay, so let's go. So thanks once again. Let's see if I get this working. Bear with me. Might have some technical difficulties. Okay. So yeah, look, thanks for dialing into tonight's webinar. We're going to speak about short puts. I think we've pretty much done everything else, right? So we've done the long calls, short calls, long puts, and now we're doing the last leg of that 2x2, which I showed you guys about. But before we do that, and I get my little magic marker out, and really the crux of today's show is all about this. But I wanted to give you guys, I spoke about natural resources and so forth. So just wanted to give you guys a little bit of an overview of West Africa, where I live. All right, so I live over here in Senegal. But for people who are interested in natural resources, particularly gold, copper, cobalt, and the like, here I'd say I'm just going to do a little bit of a drawing, pretty much all the way across Mali, back end of Senegal, all the way through to Burkina Faso. You've got a pretty significant gold belt. And you've got a lot of mining also, and mining activity in the Ivory Coast and Ghana. In fact, I was down here, just came back from about a 2-week stint in Ghana and back home to, oopsie daisy, back home to Dakar. And next week I'm going to Ouagadougou in Burkina Faso. Got a gold mine operation there. You've got surface mining operations and underground mining operations pretty much throughout West Africa. And West Africa is kind of interesting, particularly for the EV buffs and people who are interested in renewables and so forth. So big copper mines and so forth, and cobalt in the Democratic Republic of Congo. Oh, excuse me. In Madagascar over here, you've got some huge nickel mines. I just put a big N there because my magic marker's not working. The oil and gas guys, I actually started my career in the oil and gas industry, and I also worked in Nigeria. So pretty much this whole Gulf here is oil and gas. And then I mentioned to you guys pretty much of West Africa, or a large part of West Africa as well, has all sorts of natural resources. Big on gold, so Mali, Burkina Faso, bits of Senegal, the Ivory Coast are really big on gold, but others as well. So, and holistically, it's something that I trade quite regularly. And I was discussing with Will just before we were online, how I trade. And we'll speak a little bit about that as well. Often I'll use futures contracts, but also ETFs. So let's just crack on to the main part. Let's see if this works.
I had a question. I don't
Off you
know
go.
why you were on the map. I saw all those mines you visited in many different countries in Africa.
Mm.
Are you flying? Are you driving?
So
What's the security like? What's needed? When you make that trip.
That's a really great question. So Ghana's pretty easygoing. So for example, there I flew to Accra, then I flew to Takoradi, and it was a 2-hour truck ride basically up to a mine in Tarkwa. When you go to places like Mali, which is just, let me get my little magic marker out. This big country here is Mali, and Burkina Faso. These countries are pretty much, how would I put it, in the midst of civil wars and military coups, right? So the top end of Mali up here is pretty much, ISIS and jihadist territory. So I think you guys probably remember that I think it was Gaddafi was deposed by NATO and the West, and in Libya. And then from there on in, you had a whole heap of terrorists and terrorist movements move all the way down the south through the Sahel. So this pretty much, the northern part of Mali is pretty lawless, and good parts of Burkina Faso as well. So when I'm in Burkina Faso, it's a convoy, armed guards, guys with shotguns and stuff like that. You also have that kind of thing in the southern parts of Nigeria, so down in the Delta, where you have a lot of kidnappings and stuff like that. And normally it's 3 cars, you're in the middle, guys with AKs in the front car, guys with shotguns in your car, and then in the back as well. So it is, if you're used to it, I guess there's a bit of a novelty factor for the first or second time, but after you kind of get used to it and you just don't really pay much attention. The other one, I guess, for Nigeria, which is oil and gas, is helicopters. So offshore is Sikorsky 76s. So I was living in Lagos down here, this one down here. It's the second biggest city in Africa, about 25 million people. There's about 250 million people in Nigeria alone. And that there is helicopters and offshore. And I'm just not a big fan of helicopters personally. But it gives you a bit of an overview. And I'll probably take some snapshots and stuff and try and share that with also my experience of the derivatives industry and try and mix it with natural resources or whatever. So yeah, pretty interesting. You get to see a lot of the world, and I kind of enjoy that. So let's keep going. And you guys know the drill, right? The 2x2. This is kind of the first thing that I started off with when I was learning how to use derivatives back in the day, I think 2017. And I think I'm a subscriber to MarketChameleon since about then, or 2018 or thereabouts. And I used to hold a little bit of a cheat sheet in my pocket because I was really kind of confused. What's a long call? What's a short call? What's a long put, and so forth. And it was only really until doing pretty extensive study, reading a ton of books and stuff, that I started to understand the Greeks, directional risk, time decay and stuff like that. So today we're going to speak, we've done pretty much all these already. You can go check the videos out. We've done that one there, that one. Okay, short calls, and we're now on to short puts. For guys starting off on the Chameleon like I did, short puts is probably the last thing I'd advise you to do. I would start off with these, which is just long calls, start basic, buy low vol long calls, and see how you go and manage positions from there. In short calls is a little more advanced because the risk is significantly higher, but also something which is really interesting to manage. So if you have here, just read through it. When you have a short put, you don't have an option, or you have an option, but you have an obligation, right? So you have an obligation to buy an underlying at a given strike at a certain time. So you've got limited gains. The most you can earn is what you sold the put for, and you have range-bound losses. And what I mean by range-bound losses is, so the stock or the underlying can only effectively go to zero, right? So if you're selling a put at this end, then your max loss is kind of here, minus what you actually sold the put for. Now, that's not technically completely true because, as you guys are aware, I think it was April 2020, if you're selling puts, for example, on futures contracts, well, we saw the CL futures contract collapse to, I think, about minus $40 a barrel at the peak of the SARS-CoV-2 pandemic. And that was never seen before. But just for your warning, I don't want people to go out and short puts and stuff and so forth and think that they're range bound by zero. You probably are on an ETF and a stock. But if you're doing this with futures contracts or things which are a bit more exotic, then those losses may be actually even bigger. So, short puts, it's almost effectively like selling insurance. This is where I would further, this is the last thing you want to kind of do if you're starting off in options, right? The first thing you want to do is basic long calls, low vol, find a position that you like, or build a narrative on economic data and so forth, and then work it from there. And the short puts, even though it's probably my favorite position and the thing I use the most now as a trader after 4 or 5 years of running a book, it's not something I would start off with. And I'm going to share some of my errors with you guys as we go along. So here, pretty simple stuff, the payout diagram, and I'm going to ask you guys, try to figure out what that actually, so that's there, that there is the payout diagram for a short put, but you can also emulate that by another position, which I'll ask you guys about a little later. So let me just move that over here, sorry. So you've got, well, unlimited losses. It's not technically true. Remember, on our payout diagram, these are our cash inflows, our cash outflows are here. So our max loss here, so this, let's just say this is a strike of, here's our strike here, of $50. Well, as the stock or the underlying goes towards zero, which is here, our max, that the value of that put is going to go negative, and our max loss is going to be here, so our cash outflows. So they are theoretically capped. But as I mentioned to you guys before, if you're selling things such as futures contracts or things which are a little bit more exotic than just normal equity or, you know, ETFs or whatever, then there really is a danger that that could go beyond that, like we've seen with crude oil futures contracts in April of 2020. Positive directional risk, it's not unlike long calls. It really is. I wouldn't call them long calls, but if you have, remember that we have, oh, I'll just do my little graph down here. I think I've got the space, but you've got your calls over here, you've got your puts over here. Remember, we have positive deltas or positive directional risk on the call side, and we have negative directional risk on the put side. But if you're selling something, so you're short a put, so you short, so you sell, right? Something which has negative deltas, well, you multiply those two together and you've got a positive, right? So your directional risk is positive, not unlike a long call. The only difference is, as opposed to a long call, time is your friend, right? So as time decays, then that plays into your favor. Now, remember also what I mentioned with time decay, you want to be selling short periods of time and buying longer ones just because of the mechanics around theta, right? As I've mentioned earlier, as we get closer to expiry, that time decay accelerates at a greater and greater rate. So you want to be short on shorter duration and then possibly long on longer duration. Now, when you're short a put, you're also short volatility, right? When you're long a put, well, when you're long a call or long a put for that matter, you're long volatility. So one of the things you could be thinking about is, well, I want to sell high, buy low. And that is true. So selling in high volatility environments is kind of the thing you do, but it's also not for the faint of heart. You know, in the last week and a half, we've seen the S&P 500 come down significantly. And this is where you want to be selling puts into weakness on ETFs and stuff like that. But it's definitely not for the faint of heart. It requires a significant degree of margin. It's really for people who are managing bigger books. If you're managing, you know, a portfolio of $2,000, $3,000, $4,000, $5,000, even $20,000, you know, selling short puts on things like Amazon or the S&P 500 is definitely not advisable. So again, I'm just sharing my experience and what I do, not really a recommendation at all. But yeah, so I want to share with you guys some of the errors that I've made as well. So, you know, I've put up here with the strikes, you know, and the, sorry, I've just got basically how you calculate a max loss. And I mentioned that to you guys already. So if we get my little magic marker out here, and if you sell your put for $3, then you start losing money at 47, right? You've sold for 100 shares. So your max loss down here is $4,700, right? Now, remember, when you're selling a put, you're effectively naked. So you also need to take into account margin, and margin is what kills accounts and what crushes accounts. So I think at some stage we'll be speaking about margin and managing margin rather than the basics of long calls, short calls, and the like, because if you don't manage margin, that's how you actually destroy your portfolio. So here, as a rule of thumb, when you're naked on anything, you're looking at about 30% of the strike, right? So for me to put a position, i.e. a short put down here, I'm looking at $1,500 of margin or thereabouts. Now, when you're talking about bigger stocks such as Amazon, Tesla, etc., you can be talking about tens of thousands of dollars in margin requirements just to put on a short position. Hence the reason why it's not advisable to get into short puts if you're just starting out in options. And the key thing you really need to look out for is, you know, not only the position per se, but also how you manage your margin around that position. So I mentioned to you guys already, if you're short a put, you have a bullish to neutral kind of outlook, depending on where you position that put on the options, or the options chain per se. Positive directional risk we spoke about already. Time's your friend. Time decay is on your side. Sell high, buy low in terms of volatility. Look, I kind of agree with that, but it really is on a case-by-case basis. And I'll show you where it's not a good idea to sell into high volatility moments. You can roll down and actively manage. That's what I do with SPY. But you have to be super duper careful, particularly around earnings periods. It can be really the house of pain if you start shorting puts, on things like, we had Netflix go down maybe 30, 40% post earnings when it posted a terrible print and gave guidance of 2 million, subscribers less over the following quarter or the following year. The stock tanked 40%. If you short puts there, you're going to be, pretty much destroyed. And so it's very important to manage puts. It's something that I've learned the hard way, is to try and avoid managing or shorting puts around earnings. Now, I asked you guys, what does this look like? Remember the payoff diagram? Well, it actually is the same as a covered call. Remember, your long equity looks like that, and your covered call looks like, looks like this. So essentially, you've got a payoff diagram which is similar to a covered call. Now, directional positioning is pretty cool with short puts. Where you choose to position your short put, either deep in the money or deep out of the money, will dictate not only your directional risk exposure and so forth, but also the amount of risk you're taking on, etc., and the margin requirements specifically for that position. So deep in the money, you're extremely bullish, and you can take on risk exposure the equivalent of 100, 100 deltas, whether it's SPY or whatever, and essentially take a cash inflow to do it. At the money's kind of bullish, we're talking 50 deltas here, and you go deep out the money, and you're kind of either neutral or you have a generally positive overview on the underlying, right? So here, pretty important as well, strategic income and target pricing. And what I mean by this is, if you guys have done a whole heap of study on an underlying stock, you've read through the financials and stuff, you've looked at the economic data, etc., and you say, look, I want to take a position in this stock. There's a couple of things you can do. You can go buy 100 shares straight away, or you can actually just start selling puts when you've got some downward price action on the underlying. Just sell puts, maybe 5% under the strike or whatever, and then start to generate a little bit of income, right? So you're selling into weakness. I do this very often on the SPY, and you're also reducing your average cost, right? So if you like the SPY and it's just created just recently, let's just call this our SPY, right? When it comes down, you can just start selling puts at a given percentage below, and then start taking the income. If it goes through your strikes, you can roll it. And the S&P, the S&P 500, even though we've had a really rocky time this year, I'm pretty confident that in a year's time, 2 years' time, we're going to be up. And you get paid to wait rather than just buying that position. You're actually earning an income, and things like the dividends and so forth are also priced in. So here's my I've got a little diagram here of the S&P 500. This is counterintuitive. It's not easy to do. With the S&P 500, on big movements to the upside like tonight, I think about 2.5%, you could be selling calls, but I don't recommend it because you can get crushed with the positive price action of the S&P 500. As I've shown you on the Chameleon before, it tends to move up more than it moves down, but when it moves down, it really comes down pretty hard, right? So it's kind of hard to be selling puts into price action like this and rolling them. But if you do, you can kind of benefit from that upwards price action again. So just recently, it's been pretty good. Well, good. It's been not for the faint of heart, but selling puts into negative price action when you've got a spike in volatility on ETFs like the S&P 500 has generally worked quite well for me. So let's not get trucked away. And here's a little bit of a snapshot from Ghana where we're working. Just to give you a little bit of an overview here, this is a Cat 777. So for my American friends out there, this is one of the big boys. So this thing here has got a payload of about, I think it's about 70 to 80 tons. It goes through about 20 to 30 liters of diesel an hour, has a C26 engine. It's a real beast. And these are the kinds of things that you'll find on a mining operation, right? I would say a small gold mining operation between 15 to 20 of these at any one time. So really big beast, pretty impressive things to see. But let's not get trucked away with short puts because it can also be very risky. Here's something else that you guys consider doing, and I do this very regularly. Is it's the opposite of really a short covered, sorry, a long covered, a covered call, right? Long equity and short a call gives you a covered call. Well, you can do the same thing when you short stock, and I've just done that just recently. I've shorted Zoom, 100 shares. Now, if you want to protect yourself, which is what I've done here, is you can also buy the call. And when you buy the call, you get effectively the equivalent of what Dimitri calls a synthetic long put, right? So you buy, this is not working for me. You buy a call here to protect yourself on the upside. You short the stock, so you've got a call here. If it goes through your strike, you can call it away so you don't get too destroyed. But then as the underlying goes down, you can start selling puts against it, not unlike you do with a covered call on the long side. You've got a bit of a payoff diagram, bearish position and so forth. You've got a bit of a payoff diagram here, just to give you guys a little bit of an overview. Now, house of pain earnings periods. Now, this is where you don't really want to use short puts, at least in my experience. This is where I've lost a lot of my taking short put, insuring the underlying into highly volatile price action. And a couple of examples here, you've probably seen them all. Some of you actually may have lost money with them. I am one who has. I learned the tough way maybe 2-3 years ago. I don't know if you guys remember online, the healthcare in the dental industry and so forth. And the stock, I remember selling a call. The stock was at 400. I was not a call puts. The stock was at 400 or something like that. I thought, I'm okay selling the 260 put. I'll make $400 or whatever. This thing absolutely created post earnings. Not much I could do. When the market's closed, unlike equity, there's no after hours trading on options. So there I got, and that was the first time I actually literally got destroyed, lost, I think maybe 8-10 grand. So that, for $400, but you can lose 8-10 grand. It's really a sobering experience. Netflix just recently 40% down. Zillow, I did the opposite actually. I bought the puts and made about 8 or 10 grand. So, but you've got a range of them. Now, what I'm trying to get at here is my recommendation for you guys is, first of all, avoid earnings with short puts. And also, I would tend to avoid actually specific underlyings unless you're really sold on the stock and the company and you follow it. What I do, moreover, is I look at liquid ETFs. So, and I'll look at a sector. Getting a sector right is often easier than getting a specific ticker. So, for example, rather than choosing an oil and gas firm, you can just choose XLE and benefit from, the diversity of a portfolio of risky assets. And here are a few just to give you guys an idea. So you've got heightened volatility. You can go and trade UVXY or VXX. Monetary tightening, why not UUP? Or even, for those who actually trade futures contracts on currencies like I do, then you can even just take a short put position on the dollar, per se. And return to value, DIA, the Dow 30, or shorting the Russell 2000. The Russell 2000 is normally composed of, it's composed of smaller companies, small cap companies, which are in a more meaningful growth phase. And because of that, they're often more exposed to volatile price action, particularly in environments like this. Defense spending, ITA is a great one. Cybersecurity, I think, will be a theme for the future. So cyber, but there are a range of other ETFs you could use. Commodity boom, whether you're oil and gas with XLE, XLM for raw materials. And then the strain on energy prices, XLE is another one I use. I also use the futures contract CL, but you can also use XOP. So this is just an idea, me sharing my experience with you guys. What I do is I avoid single tickers in general. I definitely avoid earnings, and I'm more along thematic ETFs because it's generally, just studying macroeconomics and so forth. It's easier to say, I know oil and gas or oil prices will go up, rather than say, I know this stock, in the oil sands of, Alberta or, a shale play in Texas is going to be successful. So it's a bit more tricky doing that. So for you guys, really the key takeaways, when you're selling puts, you're essentially the insurance salesman. You are effectively insuring the underlying, and people who own equity will buy puts to protect gains they've made. Mildly bullish to all in, depending where you position yourself on the options chain. It benefits from drops in volatility and time decay. So remember, time is your friend. And because time is your friend, I recommend you take, if you're shorting puts, that you want to do it with shorter time frames than longer ones. It is super risky during earnings plays on individual equities. It's exactly what I mentioned to you guys just earlier. And I think it's best suited to a given asset class or factor. So, trading SPY or XLE or, XLV or whatever, maybe an asset class as opposed to an individual equity. Liquid ETFs make a great option for trading. SPY is perfect. And, you get paid for while you wait. So if you found a specific stock, if you guys all have Tesla and you say, look, if Tesla goes to $500, I'm definitely buying it. Well, then why not sell a put? And, you're going to buy it anyway, right? So why not sell a put and get paid for while you wait? You can leverage up if you need to by going deep, deep in the money, but it's definitely not for the faint of heart. And margin requirements are very big. So this is not for a small portfolio. This is for much bigger portfolios. And when you actually take on a short put, be very, very wary of your margin requirements. I'll just give you a bit of an overview just before we finish. So this here, you should be able to see my interactive brokers. We haven't been on it for a while. So you remember I actually took a position on XLE. I haven't actually closed it here. We've got the simulator. And it's done quite well, 45 grand. It's $1 million portfolio. So I wouldn't say it's done horribly well, but it just gives you a bit of an overview. So
it's done better than the market's done.
Yeah, it's done. It's definitely done better than the market's done. So outperformed with one position, but I wouldn't actually specifically do that. If it were me running that, and I did that just to show you guys how to do a covered call, I remember. But if it were me, I would probably do a synthetic, actually, long call and short put. But we'll get into that on another time period. But I just want to give you guys a bit of an overview of. Let's just look at Tesla. Oh, I don't think I can actually. The market's closed, isn't it? So I won't be able to do it. Yeah, I won't be able to do it, unfortunately. Maybe next time when the market's open, I'll be able to show you. But yeah, I'll see if no, definitely won't be able to do it. But I just wanted to see if it'll bring up my. Yeah, there you go. See down here, so I'm shorting the 865.
Actually, we're still on the key takeaways. I just noticed it didn't jump over to your interactive broker screen.
Okay, well, I'll just talk you through it. I'm on the options chain for Tesla, looking at the 865 put. I know the market's closed, but I just want to give you guys an idea about margin requirements, because when you short a put, you're naked effectively. And here I'm shorting the 865 for tomorrow. You're going to take in a cash inflow of about $900, but the margin requirement to do so is $25,000. So this really explains to you guys why short puts are so risky, because you can destroy your portfolio in one shot. And this is definitely, and I really want to emphasize that with all you guys, this is something that you start off last with. You start off with the long calls first, and then when you build up the portfolio, you get a bit more experience and so forth. You can start on short puts, but avoid earnings plays. I would avoid individual tickers and be very wary of the risks, because as markets go down, they can go down very, very quickly. And before you know it, you can be down 10, 20, 30, $40,000 on any one position where you were going to earn like 400, 500 bucks.
There's an old saying in the business about picking up nickels in front of a steamroller.
Yeah, exactly. Yeah, exactly. And that
got to be
really
really careful. And it takes a lot of nickels to make it worthwhile.
Exactly.
Jake, great show, my friend. Thank you so much.
No problem. So yeah, that was a bit of an overview on short puts. We've completed the 2x2 now. So for the newbies, they can go look at each one to try and learn a little bit about what each one does. But this one, yeah, definitely. If there's anything that you guys take away, just take away that it can be very risky and really not for the faint of heart. This is not where you start when you start off with the Chameleon. And on that note, that's kind of me done.
Oh, that was perfect. Now, for those Jake mentioned, Jake has done a bunch of shows, has walked us through everything he just talked about, puts, calls, all the Greeks. Great webinar. So all you have to do is go to the Market Chameleon YouTube channel, just type in Jake and they'll all come up. Last night, Raj did a great episode on watch lists. I highly recommend that for everyone. The way he uses his watch lists is incredible. It showed me some things. So check that out. And actually, Jake and Raj are also big. I know they've both been doing a lot of other things, so they maybe have not been as active, but there is a community on Discord that Jake created. I put a link to that in both the Zoom and the YouTube. Yeah. Highly recommend you do that. Obviously, when Jake's flying around the world and in very big trucks, he's not able to get on Discord, but there are other people in there, so it's a worthwhile experience. Thanks again, Jake.
Thanks very much. I look forward to speaking to you guys in the near future.
As soon as anytime and as soon as possible. You be safe,
Okay.
my friend.
Thank you very much. Have a good one, guys.
All right.
Bye.
Have a great evening, everyone. Trade safe tomorrow and see us on the AM show. Dimitri will have a great discussion tomorrow on actually MA earnings trade that someone asked about today. Stefan asked about it. He's a new trader and wanted to get a look into how the Chameleon was pricing something. So